So now let's proceed to the long problem. So in the long problem, you need to read through first, scan the entire problem so that uh, you'll know how to approach it and find the fastest way to solve the long problem. So what we have here, the statement of financial position as of December 31, 2019. So we have the assets, liabilities, and owner's equity. And then we have here the transactions happened in 2020. And then we have additional information here. So what we're tasked to do is first journalize all entries including adjusting entries, and then second, prepare the income statement and statement of changes in owner's equity. Third is journalize the closing entries, and then last, prepare your declaration. So first things first, journalize all entries. So start on January 1, a 12-month 10% note dated January 1, 2019 sa prior year, including interest, was paid in cash. So it has a face value of 100,000. So since we paid notes payable, we need to recognize it since we're already paying for it. Notes payable for, that's face value of 100,000. And then we also include the interest payable since we also paid interest as indicated. So that's 10% of 100,000. It's 10,000, and then we credit cash since we're paying for it. So 410,000. So number January 3. So all accrued salaries and wages were paid. So you can see here salaries and wages payable 15,000. So they are all paid. So the normal balance for salaries, liabilities is credit. So again, to recognize it, we debit it. Salaries and wages payable. And then we credit cash. That's for 15,000. 15,000. Okay. So next, January 25. In January 25, 60,000 worth of accounts receivable was collected. So we receive cash, so we debit cash. Accounts receivable. That's for 60,000. Okay. So on January 31, prepaid insurance was used up. Additional 72 repayment of insurance was made. So the prepayment lasts for 12 months. All prepayments are initially recognized as an asset. So it's prepaid insurance. So all used up. So from our balance sheet, you can get the prepaid insurance of 6,000. These are all used up. And then additional 72,000 was recognized. So recognize, they recognize prepaid expense, they recognize prepaid insurance, and we recognize insurance expense. For they recognize prepaid insurance for 6,000. And then we recognize the prepaid insurance. This is the new 72,000 for 12 months. Then we paid it for cash also 72,000. Okay. Next, in February 18, additional equipment costing 35,000 was acquired on account. So we recognize the new equipment. That's for 35,000. Equipment for 35,000. That's for account payable. 35,000. Oh, sorry. That's for February 18. So on February 17, additional 6,000 worth of supplies was purchased. So initially recognized as an asset. Supplies in cash. So supplies and then cash credit for 6,000. Okay. So next on March 25. So sales were made all on account. So all on account sales, that's on accounts receivable debit. And then sales revenue credit. That's for 80,000. That's for 80,000. All on account. 80,000. Next, on May 18, collected 30,000 from the sales made. From the 80,000, we are collecting 30,000. So since you receive cash, you debit cash, and then credit accounts receivable to recognize the 30,000 already collected. Next, on June 31, both the principal and interest relating to the outstanding note with 12% annual interest rate were paid. So, if we look into our statement of financial position, we'll see that there's an notes payable of 120,000. So since we already paid the 100,000, so our remaining balance now is 20,000. So that's notes payable 20,000. So from what we've read, the interest payable is 12,000 beginning of the year. However, we already recognized 10,000 from this one. So the remaining interest payable is 2,000. So for our interest expense, debit interest expense, that's 12% annual. So since this is on June, So the face value times 12% times 6/12, since that's only for June to January to June, which we do recognize it. That's 1,200 cash. So that's total of 23,200. So on August 18, cash sales amounting to 120,000 per week. So with that, receive cash, debit cash, and then record sales service for 120,000. Next, August 25, outstanding balance from March 25 sale was collected. So from 80,000, original 80,000 sales, we already collected 30, so we are now collecting the remaining 50,000. So again, we receive cash, debit cash, credit accounts receivable, since we are already collecting it for 50,000. Then, on September 13, paid equipment purchased on account. So, we purchased an equipment for 35,000 on February 18. So, we're paying for that. Accounts payable. So, we recognize accounts payable, credit cash, since we're paying for 30,000. Let's check again. That's 35,000 rather. 35,000 and 35,000. Next, on September 30, we pay 32,000 worth of accounts payable. Again, accounts payable, cash for 32,000. Again, next, on November 15, 40,000 worth of salaries was paid by the company. So that's salaries and wages expense, since that's expense, 40,000. So you paid it, so cash, 40,000. And then last journal entry, sales on account that amounted to 46,000. So another sales on account, accounts receivable, debit, credit, sales revenue. That's for 46,000. Okay. For the adjusting entries. So for the additional information, these are the adjusting entries. The remaining supplies, only 5,000. So from what purchased now, the remaining supplies, only 5,000. So if we check the previous statement of financial position, we have 12,000 supplies, and then we bought 6,000 supplies. So that's a total of 18,000. The remaining 5,000, so that's 13,000 supplies expense. Your debit supplies expense, credit supplies, they recognize the 13,000. Okay, 13,000. And then another adjusting entry depreciation for the year was 9,000. So yes, this is for the total depreciation, so depreciation expense. Accumulated depreciation. That's 9,000. And then, so the journal did not include a withdrawal made by the owner, a total withdrawal of 12,000, and 7,000 worth of salaries and wages is to be accrued. So, withdrawal, what accounts do we use for withdrawal? So, since we're surely getting decreasing our cash balance, so credit cash for 12,000. And then for the debit account, we can use owner's drawings. That's another 12,000. So we have also to accrue salaries and wages payable. And so payable is credit. That's the normal balance. And then we debit salaries and wages expense. That's for 7,000. So also additional adjusting entry is the insurance, recognizing insurance expense. So from our prepaid insurance of 72,000 on January 31, we incur 11 months worth of insurance expense. So debit insurance expense and then credit prepaid insurance for the 11 months. So that's 72,000 divided by 12 months. So we expense the 11. So that's 66,000. So we're now done with our journalizing entries. Then let's proceed with the requirement 2. So that's the income statement. So our income statement is composed of revenues as expenses, and we get the total net income. So from our journal entry, we have sales revenue. So our sales revenue, we have here for March 25, 80,000. And then another one here in, and then another one here. So our total sales revenue is 246,000. For the insurance expense, we have the originals, the 6,000 incurred, and then adjusting entry 60. So our total insurance is 72,000. The next, our supplies expense. So we have one entry for that. It's this one. And then for the depreciation expense, we have what we included in our adjusting entry. It's 9,000. And then interest expense. Let's go first for salaries and wages expense. We have what we accrued here, 7,000. Then another one. Here, this one. So we have 47,000. So for our interest expense, we have here 1,200. So our total expense is this sum. And then our net income is sales revenue less the total expense. So our net income is 103,800. So for the cash, we trace back into the cashier. So we have beginning of 191,000. Oh, that's 191,000. Then 91,000 cash plus what we paid here, plus also sales and wages payable paid, plus the cash received here, less the cash paid for the insurance, less the supplies, plus the 30,000 and collected another payment here for the notes payable, plus the revenue, cash revenue, and then another collection AR, plus accounts payable paid here, plus another paid here, accounts payable, and then expense paid. And also in our adjusting entries, we have here growth minus growth. So the cash is 105,800. Then the accounts receivable, we have beginning of 170,000. 170,000 accounts receivable. So less here, since we credit accounts receivable, and then we add here, we have 80, then another collection less, and another collection here, the remaining 50,000, and then another 46,000. So the accounts receivable is 156,000. For the supplies, we have here supplies beginning 12,000. Says here the remaining supplies is for 5,000. So we record immediately 5,000. Prepaid insurance. So from what we got here, the prepaid insurance of 6,000 balance was expensed, and then we bought another, and then so that's prepaid insurance bought less the expense incurred. So that's 6,000. For the land, we have here the beginning balance of 140,000 and 140,000, and then we don't have any transactions for our land. Yes, so that's 140,000. Then equipment, beginning balance of 160,000, accumulated depreciation 16,000, 160,000, 160,000. So we bought here on equipment. 35,000. Okay, that's it. And then accumulated depreciation of 16,000. Let's check again. That's right, 16,000. Plus we recorded here as an adjusting entry accumulated depreciation credit 9,000. So total, let's see if this should equal 632,800. So I forgot. So you add only here until the equipment and then you subtract accumulated depreciation. So it's the same, yes, it's the same. So it's 582,000 for the assets and then that's balance. So that's it. Thank you so much for listening. Hope you study well and then do your best. Good luck. Kaya yan. Laban lang. Thank you. Next, let's go to the second requirement. So, the statement of changes in owner's equity. So, owner's capital beginning, got it from the statement of financial position. Here, owner's capital 334. And then we'll add the net income. So we know that the net income is 103,800. Then less the owner's drawing. So we recorded here 12,000. So to get the owner's capital ending, we just add the beginning and the net income and then less the owner's drawing. So that's 425,800. So that's for requirement 2. For requirement 3, we're asked to journalize the closing entry. So what do we close? These are temporary accounts. So these are revenue and expense items. So let's start first with the revenue. So sales revenue has a normal credit balance. So to close it out, we debit it. So sales revenue 4, and then credit income summary. So we know that the sales revenue is 246,000. And then we also close the expenses. So normal balance expenses are debit. So to close it, we credit it. So we debit income summary, debit insurance expense. So basically, what's in our expense. So we just copy it. Okay. And then we also copy the amounts. So you can copy this and paste it here. So we can paste special, paste as much there. And then so the income summary, just sum everything. So that's 142,200. So basically we're just journalizing our net income. So net income summary, we have 246,000 credit and debit 242,000. So it has a balance, credit balance. So Since it's a credit balance, it's a profit income. So after getting this income, we then transfer this to owner's capital. So since it's credit, to transfer it, we debit it from summary for, so 246 less 142,000. So that's 103,800. So that's the net income. Transfer it to owner's capital. So the same amount. And then we also record the owner's drawings to the owner's capital. So owner's drawing is an expense, so it's debit. So to cancel it out, goes to temporary account to credit owner's drawing, and then debit owner's capital, since an expense and it's a decrease in the capital. So that's 12,000. There, we're finished with our closing entry. So last, we have here our balance sheet. So left side, these are the assets, and on the right side, liabilities and owner's equity. So we can get the balances from, again, in our journal entry. So from the owner's capital, can get it here from here. Owner's capital is now 425,000. So let's account for the accounts payable. Accounts payable, we have this one, the equipment. However, we paid it, so subtract again. And then don't forget the previous statement of financial position. So we have here 182,000. So 182,000. And then we have another here, payment of accounts payable. Here, 32,000. So we have 150,000 accounts payable. For the salaries and wages expense, so, okay, let's first check the original. Beginning, that's 15,000. So 15,000. That's 15,000. And then 15,000 less this, since we already paid it. And then we accrue. We accrued payable, salaries payable 7,000. It's an adjusting entry. So that's 7,000. So the total liabilities and owner's equity, it's 582,800. Make it pretty. So for the cash, we trace back into the cash here. So we have beginning of 191,000. Oh, that's 191,000. Then, with 91,000 cash, plus what we paid here, plus also sales and wages payable paid, plus the cash received here, less the cash paid for the insurance, and less the supplies, plus the 30,000 and collected another payment here for the notes payable, plus the revenue, cash revenue, and then another collection AR, plus accounts payable paid here, plus another paid here, accounts payable, and then expense paid. And also in our adjusting entries, we have here drawings, minus drawings. So the cash is 105,800. Then the accounts receivable, we have beginning of 170,000. 170,000 accounts receivable. So less here, since we credit accounts receivable, and then we add here, we have 80, then another collection less, and another collection here, the remaining 2,000, and then another 46,000. So the accounts receivable is 156,000. For the supplies, we have here supplies beginning 12,000. Says here the remaining supplies is for 5,000. So we record immediately 5,000. Prepaid insurance. So from what we got here, the prepaid insurance of 6,000 balance was expensed, and then we bought another, and then so that's prepaid insurance bought less the expense incurred. So that's 6,000. For the land, we have here the beginning balance of 140,000 and 140,000, and then we don't have any transactions for our land. Yeah, so that's 140,000. Then equipment, beginning balance of 160,000, accumulated depreciation 16,000, or 60,000. 160,000. So we bought here on equipment 35,000. Okay, that's it. And then accumulated depreciation of 16,000. Let's check again. That's right, 16,000. Plus we recorded here as an adjusting entry accumulated depreciation credit 9,000. So total, let's see if this should equal 632,800. So I forgot. So you add only here until the equipment, and then you subtract accumulated depreciation. So it's the same, yes, it's the same. So it's 582,000 for the assets, and then that's balance. So that's it. Thank you so much for listening. Hope you study well, and then do your best. Good luck. Kaya yan. Laban lang. Thank you.